special guest. It is Bob Damigella.
Hey, guys.
Hey, Bob. How are you, man? The reason why we have you here, and I think this is very important, because people are not understanding the Equity Assist program. They're not understanding how you work. They're not understanding when they should interact with you and how they should get involved. So let's take an example. Why don't we use a real life example here? And it could be insert your name here, okay? Because this is going to be you. Jim gets a phone call back from the seller, and the seller says, you got to sharpen your pencil a little bit. And Jim now knows that he has to go out and get updated financials in order to see if he can change the numbers whatsoever. When should Jim make that phone call to you to start talking? Understand it's about a $3 million transaction.
Right, exactly. Yes. And that's a great question. And I think, again, to your point, I think we do need to clarify how I can help. And I should be helping a lot more of the guys and gals on this in the program once we clarify how to do that. So I think he's in the negotiation process right now. Okay. In this business, obviously, there's only so many people that I can deal with in a day. So I don't need random phone calls. But the other side of the coin is that certainly a touch base. Hey, I'm getting close on this deal. Here's an OM. Just so that you know what's coming. There's nothing wrong with that at this stage of the game. If he's got a T12, if he's got a rent roll, certainly that could accompany it. And at that point, I can sort of start to take a look at what's happening in the deal. Not going to put a lot of time and effort into it, but I can eyeball it, look at what the cap rate is, kind of understand where the transaction is. So
okay, what type of advice would you be able to give Jim at this stage of the game, just by looking at the rent roll and the trailing 12 from a financing standpoint?
Let me answer your question in two parts. All right. Part number one is it depends.
Actually, Bob, I'd like you to answer it in one.
Yeah.
Got to put it together. Maybe a part, A or B.
Part one, part two.
Yeah.
Part one is it's going to depend on where the asset is. If the asset's located here in the New England marketplace, East Coast, that's going to have me looking towards one set of lenders, or a variety of lenders that I may not look for a transaction which is going to be in another part of the country. So part two of this answer is if we can get a T12 and a rent roll, we can actually start to look at least whether we think this is a bankable deal. Okay, whether we think that we can get up to the loan levels that are needed. And just get an overall picture of this transaction. Obviously, if someone's buying something at a 3 cap and we can't come to a capitalized value on it, then we're going to maybe look to say, we can't handle that deal. It's not for us, at those prices.
Okay, give us more of an example of what you mean by a bankable deal. Now, I know you just threw out those numbers about the cap rates being off like that, but what is it that you look for?
Well, we're looking for a company. Let's say we're going to do a DUS lender, which is going to be Freddie or Fannie kind of a transaction. Okay, any of those transactions are going to need to be, let's say, a 125 cover, unless it's a central business district, which might be Boston, New York, whatever. And you're going to be looking at a loan to value of, obviously, you're looking for 80. We're looking at those kind of numbers, particularly as we start out to evaluate the transaction.
All right, what type of debt coverage ratio are they going to be looking for?
No less than 125.
Really? So yeah. Okay, so right there, 125
for a DUS lender.
Okay.
And again, if it's in a central business district, we can get sometimes down to 120.
Why is that?
How do you mean?
Why does a central business district allow you to go with a lower debt coverage ratio?
Oh, it's because of the less risk in a downtown market like Boston or New York than it's going to be in a more remote area, or an MSA which is not so centralized.
Interesting. Now, what about the borrower? What are you going to look at when you look at Jim? Now, hold on. Before you answer it, I want to answer Brendan. Brendan said a DUS lender. It's a DUS lender, DUS. DUS, delegated underwriter and servicer. Those are the people. See, Fannie Mae and Freddie Mac, they don't make loans. They just make the money available to DUS lenders who go out and make the loans on behalf of Fannie and Freddie.
Thank you, Charlie.
You got it. All right. So go ahead and explain, what would you do about Jim? You're gonna.
First of all, I want to know if he's a blonde or a brunette.
Yeah, Jim. I think he's a blonde.
There we go.
Maybe a little ginger. I couldn't quite tell by the picture. So,
I mean, look, one of the first things we've got to get figured out is where are you going to source your equity? Are we going to be part of that process? Are you coming to the table with any equity? Do you have absolutely no equity? And is this going to be an exercise in just underwriting a deal and no one's ever going to be able to close the transaction? So what we're going to look at is kind of what your financial situation is. Are you going to syndicate the deal? Will you be going to investors and that sort of thing? Okay. The next thing that we're going to look at is exactly what you say is what is your biography look like in terms of your background, your history, and this is a large part of where Bob can come in for some of the newer folks, where if Bob participates in the transaction in some way, shape, or form, we can, if the bio of the borrower isn't quite as strong as we would like, if Bob participates, that can help an awful lot.
Okay, just so everybody on here understand, we're talking about Bob Bryanton, who is we call him Uncle Bob. There he is, big wave. But just so everybody understands, part of what we do here in the owner forum is we help you get over these roadblocks. And one of the roadblocks that people come up against all the time is that they don't have the gravitas. They don't have the balance sheet. They don't have the income requirements to be able to qualify as a key principal. So we figure out what the needs are, and we introduce you to KPs. And Bob is a solid citizen, and he's stepped up on many people's deals. And we have other people involved in the organization that can qualify as well. And so, that is what. So Bob Damigella looks at who you are and says, "You're good, but you're not that good. We need somebody a little bit stronger who can lift you up." And that's what Bob Damigella was talking about when he goes to when he was mentioning Bob Bryanton. So.
Yeah, let me quantify that. Actually, I want to be more specific. If there's a bio and a track record and historical background of deals that you've owned and a portfolio of assets, that's what Bob brings to the table. Okay, and I think that's super important for some of the newer folks. But I also want to quantify in terms of a DUS lender. For example, if we're going to get you a Freddie loan, okay, or a Fannie loan, they're going to be looking for 9 months principal and interest liquidity, and they're going to be looking for a net worth of at least the amount of the loan. Okay, so if you did borrowing $2 million or $3 million or $4 million, they're going to be looking for that. And this is for an agency lender. Okay, 80% loan to value typically on these small multi-family platform. But that's again where your program, and it's not a pitch for your program, but it's an amazing resource. Is that if you're a new guy and you're not worth $2 million, but you need to borrow $2 million. If you guys all come together and back the transaction, that helps you to get done.
Yep, excellent. Now there's some. Let's people keep throwing your questions on the chat box. We will not hang up until we get through all the questions, but I want to keep Bob on track here. So Jim, here's what you say. He's not quite ready. We're still trying to figure things out. He then goes and he gets the trailing 12, negotiates the deal, gets the purchase and sale contract executed, and the games begin.
Okay. And now this is, go ahead.
No. So this is, now what does he do with you? When do you get involved at this point?
I need to be involved already, because at this point, you've got a time clock of when he's going to need to go hard on the deal, right? He's got a due diligence period, and he's going to have to put cash down, right?
Yep.
So this is where it can get a little bit hairy, because depending on the equity position, things need to get done. Money needs to be available, and with closing dates out there, that has to happen. Clearly, you don't want to get to closing date and not have the equity in place. So you do need to be moving on that part of it. And also, I need to be underwriting the deal with the anticipation of getting to a closing. And you're looking at Freddie and Fannie transactions, which I think are most applicable to the group here. You're talking at least 6 weeks. They're not quick, so it could be 8 weeks. And I know that Bob Bryanton's had some experience. Bob, you as well feel you're looking at about a 6 to 8 week time frame on those, right?
Bob, I just unmuted you if you want to speak.
Yeah, definitely. And that's if everything goes right.
And that's if everything goes right. And let me tell you something, it doesn't always go right. So I guess what I'm saying is, in this business, there's a lot of things that are happening simultaneously. And certainly if you're about to sign a P&S, I very well best be on target on having T12, copy of the P&S, P&L, all these aspects in place so we can start to formulate what we're going to do here. And I think the sooner the better when it gets to that point. The point I want to, I don't want to do is I don't want to take a lot of anybody's time, including my own, with just thoughts. Hey, I like this deal. I might get it. We're not close. I haven't made an offer on it. I don't have an LOI in. And then there's actually getting in, and you've got a deal that's close. You know that feeling, and you know when you're close, and you got that last negotiation. P&S is going to happen. That's a great time right around there.
All right, let's talk about this. I want everybody to try to understand this in the real world concept. All right, Bob and the two Bobs just said that a Fannie Mae is going to take potentially 60 days if everything goes right. Now, we go in there with a lot of the times with our letters of intent and subsequently our purchase and sale agreements where we put a financing contingency in there for maybe 45 days, maybe 60 days. And that's as far as you can possibly go and still get an offer accepted. I mean, if you go longer on that purchase and sale agreement for the financing contingency, it's going to be tough to get that seller to agree on anything longer than 60 days for a financing contingency. Whereas we now heard from two guys in the know that it takes Fannie a while. If you're not on the first day, day one, you probably are going to miss the mark on the financing contingency. Now, what we put in the letter of intent is we ask for an additional 30 days if so needed by the lender. Okay, that's great. But let's put this into reality here, guys. What happens on the 59th day? After the 59th day, you're going to be hard, or you're going to be, depending upon how you negotiate it with the seller, you might have to put up some more earnest money and make it hard on day one to buy that additional time with the lender. Do you?
There's a lot of things that go on as you get close to that closing date, and if you need more time, I'm going to tell you that 10 times out of 10, 9 times out of 10. You get close to that, you've been in an underwriting process. First of all, as a broker who's well respected and does a ton of business out in the marketplace, we can always get you a letter that says, we're in the underwriting process. We're going to need another, couple of weeks, whatever. And most sellers who've already been down the road, they've had the property off the market for a couple of months. They're out there just shopping to keep your hard deposit. That's not really what they're trying to sell a property. Okay. So at the end of the day, as you get closer to that, we come across this all the time. We've got to make some provisions, and you may have to contact your seller. You may have to get an extension, put up some more money, provide them with documentation or a letter, but often we can get a little bit more time, and often the buyer typically gets more time.
All right, but here's the thing. The reason why we put the financing contingency in there is because we're waiting to see if the bank's going to say yes. Right. And what you're saying is the bank hasn't even finished that yes or no decision. And so do we let this go forward? Because, okay, fine, we'll give you a letter letting you know we're still in the underwriting process, but does that mean that, we are now hard?
No. I'm talking about a closing, Charlie. You're getting into a closing in 60 days. We're going to know where we are prior to then.
Oh, okay, fine. Yeah.
We're going to have commitment letters. We're going to have all those things in place. Yeah, I apologize.
All right, yeah.
That's why I said all that stuff's been in process. Everybody knows where they are,
Okay. All right,
sometimes I have a deal today. We're closing tomorrow. We didn't get. It's a multifamily in Florida. It's. I don't think we didn't get the commitment letter until a week ago. But it's just kind of the way the process goes.
All right, now let's talk about this because I see that Deirdre wrote a question about local lenders, and I've had some nightmarish experiences with local lenders because of they go to loan committee and everything they told you beforehand. Is out the window because somebody at loan committee doesn't like the way the way the property looks. How solid are these commitments, and what exactly can we do with them?
Well, a term sheet is
Term sheet, I'm sorry.
a term sheet is not, is often not even worth the paper it's written on. They're so flexible. Obviously the goal when you go out to the street is to generate term sheets, but there's a lot of outs for the lender. But that's your beginning stage, your first step in the process. There's nothing to be afraid of. It's the normal course of business. But term sheets are not nearly as solid as the other documents that come through the process, like a commitment letter and things like that. You should be aware that no matter what you're working with, whether it be a local bank or whether you're working with a lender like the DUS lenders, etc., you're just it's just gonna take time. They have different committees and things like that are gonna conceivably cause you some hiccups along the way. You need to be prepared to persevere through the process. It's not an easy process.
All right. So now we finished the due diligence. We've uncovered a few things that don't look right. So now we go back to the seller and we're trying to work these things through. Let me give you an example, guys, what I'm talking about. Because this happens to be going on one student's deal. They just completed the due diligence, and it turns out that the rent roll security deposits are different than what he came up with on the leases. And the seller's solution is, oh, I'll just change the leases. And, I said, you got to be kidding me. That is not how we solve this problem. But now we've got to figure out exactly what we're going to do. So now we're back to discussing with the seller as to what we need to do with this particular provision and how it's going to be fixed before before our money goes hard. Because if we can't figure it out, that's a cost that the buyer should not, my student should not have to bear. So now we get through the final negotiations of the due diligence. We're ready to move forward. We're at the last day of the inspection period, and now the day passes. We're now conditionally hard with our money on the financing contingency. What do we do with you, Bob? What are you going to want? What type of documents are you going to need?
Well, keep in mind, a lot of that stuff goes on between you and the seller. If we've underwritten, for example, again, working with the DUS lender, we've underwritten and the terms in the term sheet, and we have a cash flow, a net cash flow that we can get to, because they're going to underwrite it. Charlie, you still there? There you are.
Yep.
We're going to underwrite this thing based on the represented cash flows. And what simply happens is, if you get to the closing and you can't hit those represented cash flow numbers or any of the terms, which is going to be your insurance or your taxes that flow down to the cash flow that asset is going to generate on an NOI basis, okay, and it comes up short, you'll just get less proceeds. And if you get less proceeds, then you're in a little bit of an issue where you're gonna have to come up with money out of your pocket or from your investors.
Okay, perfect.
That answer your question?
Yes, it does. And let's move on, because that's I think there's another step in there that we haven't quite got to, and that is now that we are full bore on this deal and we're engaging you, what's the first thing you're going to need from us? Besides, we've already done the T12 and everything. What is it that you're going to need from us in the form of a check?
We're not looking for we take all of our transactions or all of our assignments on a success basis. We don't take any fees up front. We don't take any deals, though, that we don't think we can get done. Okay. So if you engage us, you're going to get an addendum A on your engagement letter that details out all of the items that we need from you in order to do this. And that's could range everything from a plot plan to bios to your personal financial statement to all the documents in the deal, etc. But as far as engaging us goes, we are not taking any funds to be engaged, and we've been doing this for 25 years. So. Oh, okay. But you're still missing this one thing, because I'm going to have to write you a check. And what is it for? And how does it work? At the end of the day, any payment to our firm, because we're brokers, are going to be in the closing statement. So ultimately, we're going to be paid out of proceeds in the transaction. You're not writing me specifically a check.
Okay, I'm all right. Not to you. I guess you're missing my point.
I am missing your point.
Third party reports.
Oh, yeah. I mean, I'm sorry.
Well, I understand, Bobby. I mean, you got 500 people watching you right now,
That's
and
okay.
You can get kind of nervous.
The last deal that I did just this week, again, that I'm discussing with you, they had a $10,000 deposit when they signed on the term sheet. So that took care of ordering all the, as you just mentioned, documentation, the appraisals, and all those items that need to be done for the transaction.
All right, so kind of give us a ballpark as to, with Jim, he's got a $3 million deal.
He's going to put up $10,000 to $15,000 in deposits just to get us a term sheet on the deal.
Okay, and so what are the reports that he's paying for? Because this is not, and this is where people get confused.
Right.
And this is the type of thing where we just need to figure it out and we get the situation solved. This is money to your firm, but it's for third party information.
Right, but it would not necessarily, Charlie. Hang on, I'm just trying to pull something up for you.
All right.
To answer your question. So that we're not talking about money specifically to me, okay?
No, and this is the thing.
Here's an Arbor commitment letter right here, okay?
Okay, but let me just explain, people. Bob said that his firm only works on a success basis, and let me tell you, folks, that's what you want to hear brokers say. You do not, and I've had to have so many conversations with students about these brokers who are looking for an upfront fee.
No way.
Yeah, it doesn't work that way. If you find a mortgage broker who wants a check from you in order to engage him, I'll tell you right now that the checks are a one-way street, and they're from you going to him, and he's never going to get you any money. That's not the way this deal works.
It's not the way it works, and I would tell you that it's not an easy business from the standpoint of getting deals done. They're hard to get done, so the chances of you having money at risk is very high if you pay up front. But I want to answer your question now specifically because here's an Arbor loan application right here, okay? And this is, I'll give you a specific. I wish I'd known I would have had this ready. This is for a $2,530,000 loan. It's a 4.65 rate. It's a Freddie Mac fixed rate, okay?
Non-recourse.
Non-recourse, of course. The loan application fee, to answer your specific question, due upon acceptance of the letter of interest, we waived the loan processing fee in this one at the closing, $2,000, but it'll pay for site inspection, required third-party reports, appraisal, precondition assessment, environmental site assessment, level 1 seismic risk assessment, legal, closing deposit paid to lender's legal counsel to begin work in connection with the proposed loan request. So that's what you're talking about in terms of what the deposit's going to be to get you started in this whole program. And again, I'm using a Dust Lender as an example.
Right. So in other words, folks, when we get to this stage, we're buying this property. And these are expenses that show up on the sources and uses, and they are reimbursable when you raise the private money. So you put the money up, and you're going to get it back. Right. That's how we structure our deals.
Absolutely.
Yeah.
So.
All right. Let's because I got to keep my eye on the time. So let me go back here and see if I can find some questions here. Here's one from Craig. What's the minimum amount for Gertica to contribute equity and to get involved with the equity raise?
Well, that question doesn't really apply. I mean, it's, what's the size of the transaction and the cap stack? What we're looking at is, we want to see an underlying loan of, $2 to $3 million. Like that was $2.5 million right there on a minimum basis. So what's your equity going to be on top of that? Obviously, if you're at an 80% loan, at that 80%. So, the equity component to anything that we do is completely dependent upon the transaction, and but the whole capital stack should be at least no less than about $3 million.
Okay. All right. At the minute. Okay, I see what you're saying. Okay. Now, Peter asks, you need a KP versus net worth. Now, Peter, if you've got the net worth, you don't need a KP. If you can qualify on your own, qualify on your own. If you're a person that doesn't have that, but you still want to, start buying multifamilies, we're going to solve that problem for you. We're going to find you the KP so that we can get that get over that hurdle and move on to the next one.
The only thing, Charlie, is it does help to have a KP, like, in your program, even if you have the net worth, because sometimes you don't have the track record.
Right.
Okay, this is your first multifamily, and you want to buy 250 units, for $14 million. And okay, great, you've got the net worth, but have you done this before? No. And that's where you can definitely, the KP program is helpful for your students.
Yeah, back before 2007, if you fogged up a mirror, you could get a multifamily loan from Fannie Mae. But now, they want to see people, because there were so many California investors out there running around not knowing what they were doing. So, all right. So, Deirdre asked a good question, and I want to hear your answer on it. When should we look to use local banks versus DUS lenders? When's the best time to use a DUS lender versus a local bank?
Well, it depends on your deal, and always the answer is depends. You're probably not going to get as high of an LTV or an LTC from a local bank necessarily. Obviously, the DUS lenders get you up to around 80% loan, which then is less of an equity requirement, and I think that's helpful for most people on the call. Banks are banks, like you say, they have committees and so forth. But if you got good bank connections and they can get you to the LTV that you want, then certainly go for it.
Yeah. Yeah. And so the other thing, not only the LTV, you're going to talk about a higher interest rate with local banks. The difference that I've found in working with local banks versus DUS lenders is when you get into trouble with a property, like when the market crashed that time back in 2007,
right?
I was able to restructure the debt with a local bank. Don't even try to do that with Fannie Mae.
Nope. Not going to happen.
Not going to happen.
I would tell you this much, and again, I'm using it as an example for today, but I think that there's a lot that we can get done with Fannie and Freddie just because of the nature of our firm. I think I mentioned to you this before. We could help out on some tough deals that really take some finesse to get done. Working with a local bank may not quite always be as easy. But yeah, the banks will work with you. And yes and no. I mean, the bank loans will have covenants. Does everybody know what covenants are? Familiar with those?
Yep.
Important to be aware. Covenants are going to be in your bank lending documents, which not to scare anybody, but you got to be aware of them because you could be looking at a requirement for equity if the market has a downturn.
And can I just interrupt here and say that in the coaching archives, there's a whole I did a whole lesson on Fannie Mae documents, and I went through all of Fannie Mae documents. I have a video on it, so you can see exactly what it means and how it ties in. I mean, perfect case in point. You sign a personal guarantee on a non-recourse loan,
right?
And that's all explained in the video. So if you have any questions about that, you can check it out there. Okay, let me ask this. Deirdre asked a question. Can't you ask for more time when the seller causes a delay? Okay, Deirdre, if it's not within the four corners of that contract, it doesn't exist. If the seller causes a delay and you let him, then you have to abide by the terms of the contract that you've agreed to. If the seller causes a delay and you're still at some point, within the inspection period, terminate the contract. Terminate the contract, figure out what the problem was, get it fixed, and then get back under contract. But remember the number one rule. Somebody unmute yourself and please state the number one rule.
Stay in control.
Stay in control of the deal. And if the seller is the one who's dragging his feet and causing delays, who's in control of the deal? Seller is. Yep. Don't let him control the deal. You control the deal. If he's doing it, you terminate the contract. You let him know, hey, I'm going to keep my earnest money on hold, but I'm not going to put it at risk with you until we get this thing figured out. So that's how you do that. All right. Hey, Deirdre asked another good question. I saw this one come up, and when I was going to ask the same question. Can we get a sample engagement letter? Like what does it look like? And can you send us over a template? Send it over to me and I'll blast it out to everybody.
I suppose I could do that. Sure.
Yeah. Just, pull out all the names. Bob asked a question. What about a rate lock fee?
Oh yeah.
Why don't you explain that one?
Well, that's when you do get the commitment letter, and when that comes in, it's time for another deposit, which is usually 1% of the transaction, and then your rate lock. So if it's a $2 million loan, you can do the math. You don't need me to do it. So it's another, couple 20 grand. So.
All right. Now, Larnie, I don't think Larnie's asking a bunch of questions here. I'm going to try to get some of them answered. I don't think we're going to answer them all. Will you consider other types of properties other than multifamily?
Sure, absolutely. We do office, we do hotels. I'm working on a hotel in Rhode Island right now. We do a lot across the board in different areas. Sure, absolutely.
But do they always involve real estate, or can you just do a business?
No, it's real estate.
Okay.
I mean, some real estate has businesses in it, but it's real estate.
All right. Now, is there a minimum or maximum price that you get involved with?
It's really loan amount if we're talking about the debt side of the transaction, and it's got to be that $2 to $3 million on a minimum basis.
Okay. Now,
so
do you get
the math from there, right?
Yeah. Do you get involved with self-storage facilities? I'm trying to go fast because I want to. I see so many messages down here.
Yes, we do. Yes.
Oh, you do. Okay.
Yes. Yep. Sure. Absolutely. We funded them. Absolutely.
Yep. Ann Maxwell says, Charlie, can you post all the form samples on the owner's site that we need for Bob? Yeah, that's a great thing, Bob. So I really do think we need to get that that from you.
Just remember one thing I can send you a sample of an engagement letter, but every one of them is custom done. It all depends. I hate to say it, but it's really the case. Every transaction is different. Some deals have equity, some don't, some are just debt. So if there's something I can provide you that's sort of a sample, I will. But whenever we engage your deal, there's going to be a specific, sometimes the tail terms, the length of the engagement. If it's construction, is going to be longer than not. If it's a construction loan, don't mean to be I'm trying to move through this quickly, but engagements are all different. That's a great question to ask in theoretically, but every engagement is really custom done when we do it and the letter will be custom to that particular transaction.
Okay. Now, Deirdre, it's like she should have lived my life a couple of years ago. All these questions are like, oh man, I remember having these exact same questions with my wife. Do you lose the money if the deal doesn't go through? If it doesn't get funded?
Well, again, there's no money to us, so it's not that. But all of your fees along the way.
Like if we end up not raising the private money, and we're like short, I mean, yeah, all of those fees are gone.
Yeah, it's gone. I mean, and not to mention the fact that you really don't want to put yourself in that position where you get to a closing and you didn't have the equity to close.
I know. So
we've seen that before, Charlie, right?
Yeah. I never have. We've always closed every deal we went after, but I know what you're talking about. And,
right.
You had a situation with a couple of other investors where Gertica actually kind of ponied up the money to put these guys over the top, which was kind of nice.
Yeah. We had a group that they had $350,000 hard on a deal, and they weren't able to finish the underwriting and get it all done. This doesn't happen all the time. But we were able to arrange a bridge loan for them to bridge the transaction, close the deal. And we're right now, the one I'm talking to you about is the refinance of that bridge for $2.5 million for that multifamily in Florida.
Yeah.
So we got them over the hump and saved them $350,000. And they, this is the type of firm we are, though. They only paid us once. We're not getting paid on both transactions.
Cool.
Yeah.
All right. So the fees that you pay are paid, obviously before the close, but after you have assurances, the deal will close. In other words, once we know that you guys are going to give us a loan, well, I guess that's not true, Paul. Like, I mean, how many times did it happen where I put up all the third party report funding fees, and you guys come back and say we're not doing this deal?
I mean, if you're that far along the way, guys, honestly, if you're not sure you're going to have the equity.
No, we're not talking about not having the equity. We're talking about you coming back and looking at doing a personal needs a physical needs assessment, or the appraisal comes back and it's off. I mean, we were counting on your underwriting as well. What happened?
You're saying to me is that you get to the point of underwriting with the DUS lender?
Well, we've been talking to you since we got this deal under contract.
Right.
You've
Right.
been looking at trailing 12s. You've been doing everything. We've
Sure.
been keeping in touch with you. You give me the term sheet, and we go through the due diligence. We're like, okay, Bob, we're going to buy this thing, and we
Right.
stroke you a check for $10,000 to $12,000.
Right.
The third party reports. You go out there, you do the third party reports, and you come back and say, "Now we changed our mind. We're not going to do this deal because the appraisal didn't come back, or
Right.
the physical needs assessment was so bad that you said no to the deal."
Yeah, your first deposit is going to be non-refundable, and if your deal doesn't appraise out, whatever the case is again, we're not the lender. Obviously, there's that risk, but 99% of the time, if we've got your T12, run the numbers, looked at the deal, done a cap, I mean, the appraisal doesn't usually not come back when you've done a capitalized value, unless your numbers were so off that the valuation is not there because of the cash flows are not there. But bottom line is, without even seeing a property, you can know what a valuation of a property is based on its MSA, its cap rate, and its net operating income. If that has changed, you'll get either less proceeds or no deal.
Okay, so the physical needs assessment comes back, and because I was in a situation where we bought a property, and with the first lender, the physical needs assessment came back and killed the deal.
Right.
And then we went out and found another lender.
Well, we can do that too. I mean, you got to remember something, and I think that's a great point. If we go to one lender, and for whatever reason it falls out, and that can happen, we'll find another lender to get the transaction done.
Yeah. All right. How can we reach you, Bob?
Let me give everybody my email.
And if somebody wants to type this into the block, I'm still scrolling.
Here, I can do it. I can type it in, Charlie.
Okay. And Larnie, use about 4.5 for the interest rate in the analyzer. Unless it's a small property, then we're going to like $1 million or lower. Then we're going to use a higher interest rate and a shorter term. We're probably going to be dealing with a local lender, and therefore the terms will not be like that of a Fannie Mae deal.
Right.
Bob, if needed, can we provide all the equity needed for down? So Bob D, if needed, can you provide all the equity needed for down payment?
No.
It's called the Equity Assist program.
Exactly. No. And let me give you that whole point real quick. I know we're getting to the end here. We're going to help you in certain cases for the right transaction to assist you in an equity raise if it makes sense. There's a lot of variables that go into that, but we certainly can help and have done many, many times over the years. But I like I say to everybody, equity is a best efforts basis. It's all hands on deck. Even if we take the assignment to assist you with the equity, it still means that you're calling friends, family, and you're putting your own efforts into helping to raise equity and coming to the table to even start a conversation with at least 10% of the equity piece of the transaction to even say, hey, can we even attempt to do this for you guys?
Right.
Okay.
Now, okay, and Deirdre keeps asking questions, and they're great questions, but she keeps asking about Jim. I'm trying to figure out who Jim is. Sorry, she figured it out.
Come on, Deidre. Bring him on.
All right. So yeah, we got to, I know we're beyond 8 o'clock and I always keep it, but we haven't even got to the meat of this as far as the equity assist and how it works. Why don't you kind of just give some color here? And this all came about because of the conversations that you and I had as a result of some of my students who are closing deals and getting the lender, the debt provider, to cough up equity. Like for instance, in the case of Manish, if I know you may not know exactly what happened in that case, but you know what your organization would do. How does that all work? Where a debt lender could also provide equity?
Well, kind of the rules of the road are we're not taking an assignment for equity unless we for certain are going to get the debt. I mean, they go hand in hand. So if we then take on an assignment to get to help with that transaction on the equity side, it is, and I've had this conversation before, and I want to be clear about it. There's a lot of variables. It's to no way suggest that we don't get it done. Here's a flyer for one of the deals that we did, which was a Class A office building, and it was a debt financing of $10 million and a $3 million equity financing. Okay, it had a pref rate on it of 9%, and the sponsor came up with 15%, and we worked on the other 85% of that $3 million raise. Okay,
yeah.
So and again, everything depends. It's if the marketplace really, the market plays a big role in whether or not something is gonna, we're gonna be able to raise equity for it. I mean, let's face it, it isn't just cherry picking the very best deals, but if you've got a C-class, multifamily on the border of Mexico down in Texas somewhere,
that's giving you an 8% cash on cash return
or less, we're not going to be able to help. I mean, the numbers have to work. You've got to have enough cash on cash return to pay a pref rate to attract investors. And that all depends on where the marketplace is for the rate at that time. They might be 8% or 7% for a Class A building, but for something that's a Class C, investors say, hey, if I don't get 12% of my money on a minimum, pref rate basis, and then I want an IRR of, 22. So it's all very deal specific. This is where our financial engineering or our financial technology and experience comes in. I mean, I work with a group of guys that have in excess of 150 years of experience doing this. The firm's been around for 25 years. And even I don't have the answers, and I get the answers. But the point is that at the point of raising equity, everybody on this call would take equity. But everybody on this call is just not going to get equity because every deal and every situation doesn't warrant us taking that assignment.
Right. So Deirdre asked a question about the what does it cost for your equity? Now, keep in mind, you just said 15%. That buyer only had to raise 15% of the purchase price. I think
of the equity, Charlie, of the $3 million.
Of the $3 million
equity, the total cap stack was 13.4.
Yeah.
The debt financing was 10.4. The equity financing was $3 million. We helped them with 85% of that $3 million.
All right. So you're looking at
what, $2.5 million or something?
No, that's $450,000.
Yeah, I mean, for them, about $500,000 that they came up with, $450,000.
Wow. Okay.
Yeah, and
does everyone hear that?
The IRR for the investor was 35.9, and the pref rate was 9, and the investor multiple was 326. They don't all have to be that strong, but I'm just giving you the numbers.
Okay, so I did misunderstand that. Yeah, Bob Bryanton says I'm in. Craig Cameron. Oh, I heard it, Charlie. Yeah. Okay, thanks. I agree.
But that was, keep in mind, guys, that's a Class A, 176,000 square foot office building, in New England.
All right. Final question. There's still 2 questions I'm going to have ask here, and then anything else you're going to talk to Bob privately. Yeah, and Brian, there isn't any particular cash on cash return requirement. It depends upon the deal. Do you lend on mobile home parks? Okay, 3 more questions. Do you lend on mobile home parks?
I don't think that's going to be a strong area for us.
Okay. Now let me see. What is it? What is the price to raise that money? What did that buyer have to pay Gertica to raise that money?
$1 million. No.
Yes, exactly.
No, 3%.
Just 3% of the $3 million.
Yeah. No, well, actually, roughly 2.5, 2.550.
Oh, right, 2.5. Yeah. Okay.
Yeah. So we'll get 3 points. So we get 3 points on equity and a point on debt. That's it.
Okay.
And it's all done on a success basis.
All right. Now, when does someone know if you can help or not? In other words, but I think Dr. Chi's question kind of goes back to what we were talking about originally. Is you're gonna know, and you're gonna be able to tell us exactly what you're able to do pretty early on. Like right now, Dr. Chi is we're drafting the purchase and sale agreement. You got to be involved in these conversations as a potential debt equity source. Yeah,
she and I need a phone call. I requested documents from her the other day. I've already forwarded them on to a potential lender for her. I'm already looking at the deal. We need to have a very serious conversation, though, about where she is on her equity piece. I haven't had that opportunity to speak with her yet, and I don't know exactly if she's got all of it teed up, half of it teed up, where she is. I know it's a nice property, and I've got to dig down and see where we might be, depending on what she needs.
Is there a state you won't work in? Any particular state?
I'm just going to tell you, we'll work in any state in the nation for sure for DUS lenders. I mean, even Hawaii, if it's a multifamily in Hawaii, we'll work with a DUS lender. As we get to, life companies and various banks and so forth, we're going to be more East Coast and New England centric, just for some of the different stuff like that.
All right. Then Jose asked a question. Bob, can you do a slide presentation next week with captioning for the hearing impaired, along with sign language, and peel me a grape and hold all my calls? Like, Jose, come on, man. The guy just gave the whole presentation. What do you want him to come back and do a whole PowerPoint for you? Gee, yeah, we're going to use little puppet fingers too next time to make you understand it. Jeez. All right. Is there a state that you won't? Okay. Is there a state that you won't work with us? Can you still work with us if there is seller financing? Yeah. How does that work?
It's funny that you brought that up, because another multifamily that I'm doing in Jupiter, Florida, had an assumable loan, and I'm trying to remember the numbers. It was a smaller transaction. It's about a $3.5, I want to say, $1 million purchase of a 30-unit multifamily with an assumable loan. And again, remember, I've made about $2.5 million. What we did for our client, and this is what we will do for you if you're our client, is we ran all the IRR numbers, we ran all the return on equity numbers, we ran everything based upon assuming the loan with 5 points of penalty in it, or refinancing the whole thing from scratch based on current rates and where they are. This was it was about 5.25 assumable loan with 5 points of penalty in it, and he was better off to refinance the whole thing from scratch. And that's exactly what we're doing. And we quantified all the numbers side by side, what was the best, and the client himself looked at it and said, the IRRs are better to me to pay the 5 points and just get new financing on it. So so that's how that, and sometimes it makes sense to assume it, sometimes not. Sometimes you need a supplement over and above the assumable loan. You don't need us then. If you're going to assume the loan, you're done. But if you're looking for equity for me and you're going to assume a loan, don't even bother.
Yeah. Okay. And final question here, Dr. Chi, I think you're missing the point here. Dr. Chi, you don't have to write the check for the $450,000. You go out and you raise the $450,000 out of your friends and family, as Bob had said before. This is equity assist. We're not doing 100% financing here, but does not mean that you are paying any money out of your pocket, or that many of the deals, the owners don't come up with anything. They go out there and they find money to invest. Like, for instance, I just know that in Manish's deal, he came up with very little out of his pocket to own the $36 million, but he went out and raised it among friends and family. This is the equity assist program. It is not 100% equity raise program.
Charlie, you know what I think we need to do, and I think we need to do this for the money. I think syndication. How to syndicate the equity.
Yeah.
I think that's where everyone's missing, is how you syndicate the equity. You've got if you need to raise $1 million for the equity, then you need to bring in family members, friends, and you need to syndicate that piece out to investors. And sometimes, like Charlie said, in the equity assist program, like we did in this one, you either they came up with their 450, and we syndicated. It was still syndicated. We went out to the street to fulfill that syndication portion of that. It probably wasn't one investor for a small trade like $2.5 million.
Right.
I think
so. Bob, maybe next week you can do a slide presentation on that.
Maybe not.
So, all righty, man. But you're absolutely right, and that might be the next thing we need to do. It's definitely on the list in the multifamily MBA program,
right.
Is how to do syndications. But we definitely need to, probably, Bahal Dangle. My family isn't Rockefeller, nor are my friends graduate from Eton. Well, all right, but I don't want to hear any more excuses, Paul. Get out there and make offers, okay? Come on, let's do this.
Once you get the offers and you got a deal to work with, that makes all the difference in the world. I know you want to line up your money ahead of time, like Mike is so smart to do, but at the end of the day, when you've talked to people, you've told them you're going to call them with an idea, whether it's your friends, your family, your neighbor, some guy you stopped on the street corner, he said, yeah, I love real estate. You're going to do that. And then you're going to call them that day with that hot deal. that beautiful deal that Dr. Chi has. It's a very attractive building. It's got some good numbers, and you know what? People will step in and get your deal done.
Yep. Hey guys, my father was a piano mover, so don't like think that I was born with a silver spoon in my mouth. All right, name that movie.
I know.
Okay. All right, everybody. Hey, thanks, Bob. Thanks, everybody. It was good chatting with you. This will be up tomorrow on the coaching call, and I think you've given me an idea for our next call, so we can come out and start doing some more nitty gritty, some more training. I think we're due for another training class, so maybe that's what we're going to do next week. So, all right, thanks everybody, and we'll all talk to you later. Take care, everybody.
Bye.